Montes Claras and welcome back to the 5th episode of the Forex Trading, the Foundation class. We will dive in more on monetary policies today and study actual reports and statements released by the major central banks. So without further ado, let's begin. Since the Federal Reserve System being the most powerful and important central bank in the world, our examples will be focusing on them. During the announcement of the federal funds rate, the rate statement is also released. This includes a summary of what the FOMC members saw on the economy, the rationale behind their action, and what they are saying in the future. 2 weeks after, the meeting minutes will be released. Since this is a foundation class, we will not be discussing the minutes or the in-depth economic review released by central banks and will just focus on the rate statements. What are the things that we must look at in the rate statement? First, we have to understand the general picture they are describing. Is the economy doing well? What are the risks they are seeing? Based on the data that they have, where do they see the economy is going? Are they seeing any changes in the monetary policy? Once we have a clear idea, we compare it to the previous rate statement to see if there are any changes. By comparing the two, we can see if the economy is doing better, worse, or just plateauing. Let us take a look at the January 2022 federal rate statement. Before we begin, there are a few things that you need to prepare. First, you have to determine what kind of a student you are. Are you a techer person who prefers a digital copy and notes? Or are you an old soul like me who prefers printed copies and handwritten notes? Either way, make sure that you have the right tools while we study. If you are interested in downloading the same app that I'm using on my PDF file, the link is attached on the description below. Second, you have to create your own system of taking notes. Personally speaking, I like to highlight green parts of the statements that are good or positive for the economy. If it's bad or negative, I highlight it in red. If it's something that I need to be reminded of, I highlight in yellow. Since I write on a printed copy, I like to underline some parts as well. Therefore, I will be using a pen, a ruler, and a highlighter. As a pro tip, use a friction pen and a highlighter so you can erase it if ever you made a mistake. Okay, so let's begin. Federal Reserve press release January 26, 2022. Indicators of economic activity and employment have continued to strengthen. This is positive, so I will highlight it in green. The sectors most adversely affected by the pandemic have improved in recent months but are being affected by the recent sharp rise in COVID-19 cases. This is negative. Although sectors have improved in recent months, we will not be trading something that has happened in the past. We are making trade decisions based on something that is happening and will happen. Therefore, since sectors are being affected by the rising COVID-19 cases, this is not good news. Job gains have been solid in recent months, and the unemployment rate has declined substantially. No question about this, it's positive. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. As a consumer, we do not like inflation since we will be paying more for things that we need and want. But in Forex trading, you need to stop thinking as a consumer but as a trader. High inflation usually results in higher interest rates. The central banks will try to discourage the people from spending by raising the rates. This makes borrowing more expensive and saving money in the bank more rewarding. A currency with higher interest rates enables people who own the currency to earn more, giving it more value. This is positive. Overall financial conditions remain accommodative, in part reflecting policy measures to support the economy and the flow of credit to U.S. households and businesses. This is neither positive nor negative. It is just simply describing what kind of monetary policy the Fed is currently implementing. I will highlight the word accommodative, yellow, to remind me that the Fed is currently implementing QE or accommodative monetary policy. The path of the economy continues to depend on the course of the virus. Progress on vaccinations and an easing of supply constraints are expected to support continued gains in economic activity and employment as well as reduction in inflation. This is positive. Risks to the economic outlook remain, including from new variants of the virus. This is neither positive nor negative, but I will highlight it in yellow. Since the Fed is watching out for these issues, we traders should be watching it as well. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. Nothing of importance here. You will see on the next statements that this sentence is usually a part of the rate statement and it's just a reiteration of the Fed's mandate. In support of these goals, the committee decided to keep the target range for the federal funds rate at 0 to 0.25%. This is the part where traders find first in the rate statement. However, if you are watching the economic calendar as well, this information is already available to you. Just keep in mind that there is a slight delay between the release of this statement versus the time the economic calendars update, because they will be relying on this file as well. Since there is no change in the interest rate, we will be ignoring this part and will find clues on the next action of the Fed. I will underline this part to remind me what the Fed did on the rates this meeting. With inflation well above 2% and a strong labor market, the committee expects it will soon be appropriate to raise the target rate for the federal funds rate. This is positive and, in my opinion, the most important part of the statement. If the coming inflation data remains above 2%, then it is certain that the Fed will raise the rates. The figure will highly affect how much the increase will be. The higher the increase, the more value it provides to the US dollar. The committee decided to continue to reduce the monthly pace of its net asset purchases, bringing them to an end in early March. This part is describing the asset purchase program the Fed is conducting. Reducing its value means the Fed is gradually moving away from QE. But be reminded that this does not automatically mean that the Fed will be going to do tapering. There is a neutral stance between the two. Meaning the central bank isn't helping nor tightening the economy. Before it goes from QE to tapering or from tapering to QE, it usually goes to the neutral position first. Because there is a reduction in the QE applied, this is good for the dollar. Beginning in February, the committee will increase its holdings of Treasury securities by at least $20 billion per month and of agency mortgage-backed securities by at least $10 billion per month. The Federal Reserve's ongoing purchases and holdings of securities will continue to foster smooth market functioning and accommodative financial conditions, thereby supporting the flow of the credit to households and businesses. As we can see, the Fed isn't removing its QE. It's just gradually winding it down. Still, good news. But the actual impact on the USD value will be based on how much reduction they did. This info is available if we compare this with the previous rate statement, which we're gonna do later on. In assessing the appropriate stance of the monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of the monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goal. The committee's assessment will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures and inflation expectations, and financial and international developments. Again, nothing of importance here. This is a usual part of the rate statement. Now that we have dissected the rate statement sentence by sentence, as a beginner, it is beneficial to create a summary showing both positive and negative notes. I prefer creating a table with two columns. One column for positive notes and one for negative. Then I add another row for the important notes. Now that we have created a summary, we have to decide whether this statement will bring the USD up, down, or have no impact at all. Usually, when the central bank has no new information added to the table, it does not make any change and has the same economic outlook as the previous statement. It will not have any impact on the market at all. If the statement mentions great improvement to the economy, reduction of QE, or application of tapering, then that will bring the currency up. On the other hand, if the economy's shape is getting worse, the central bank will start QE or increase its existing QE or will reduce the value of its existing tapering. That will bring the currency lower. For this statement, I believe it is generally good for the USD since the economy is doing great, plus the inflation is getting higher and an increase in the interest rate is expected. To confirm this, we can check the US dollar index. The DXY or the USDX measures the strength of the US dollar against 6 major currencies, which are Euro, Swiss franc, Japanese yen, Canadian dollar, British pound, and Swedish krona. Let us take a look at the DXY movement around this time. Let's do another example. This time, the Fed rate statement for March 16, 2022. Indicators of economic activity and employment have continued to strengthen. Job gains have been strong in recent months, and the unemployment rate has declined substantially. This is good news. Let us highlight it in green. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price measures. Higher inflation, depending on the actual figure, is usually good for the currency. I say usually because if the inflation level is ridiculously high, it could affect the growth of the economy and then the value of its currency. If you are unaware of how elevated the inflation is, we can check the economic calendar. The invasion of Ukraine by Russia is causing tremendous human and economic hardship. The implications for the U.S. economy are highly uncertain, but in the near term, the invasion and related events are likely to create additional upward pressure on inflation and weigh on economic activity. Since the U.S. is not directly involved in this war, this does not affect the U.S. economy directly. But because Ukraine is a major producer of food and Russia is a major supplier of oil and energy, the war is bringing inflation higher because of the disruption in the supply chain. During this time, the invasion has just started and it is early yet to assess its impact to the U.S. economy. Therefore, the Fed has only stated its concern on this risk and has used the word likely. I will be discussing this event further on sentiment analysis portion of this webinar series. For now, I will be highlighting this in yellow. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. With appropriate firming in the stance of the monetary policy, the committee expects inflation to return to its 2% objective and the labor market to remain strong. Again, this is a usual part of this statement, not important. In support of these goals, the committee decided to raise the target range for the federal funds rate to 0.25 to 0.5% and anticipates that ongoing increases in the target range will be appropriate. This is positive for the USD. The real-time impact is determined by the forecast versus actual figure. In addition, the committee expects to begin reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities at a coming meeting. Any reduction in the existing QE is good for the value of the USD. It only means that the economy is doing well and could afford less stimulus from the central bank. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of the monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures and inflation expectations, and financial and international developments. No impact here as it only affirms the Fed's mandate to protect the economy and the USD. The Fed does not always remind people of its mandate, but when times are rough, they are likely to communicate it clearly. Sometimes, the market needs a good reminder to avoid getting shocked. One thing the Fed does not want to do is surprise the market and disrupt it. Voting for the monetary policy action were Jerome H. Powell, Chair, John C. Williams, Vice Chair, Michelle W. Bowman, Lael Brainard, Esther George, Patrick Harker, Loretta Mester, and Christopher Waller. Voting against this action was James Bullard, who preferred at this meeting to raise the target range for the federal funds rate by 0.5 percentage point to 0.5 to 0.75%. Patrick Harker voted as an alternate member at this meeting. If all members voted unanimously, then this portion is not important. However, in this case, James Bullard has a more hawkish view than the rest. This can be viewed as a cookie point for the USD strength. So now that we have reviewed the rate statement line by line, let us proceed with the summary table. Overall, this is a bullish statement for the US dollar. Inflation figure is persistently staying above the 2% target. The economy and employment are both strong. Therefore, there is little to nothing that hold back the Fed to be stingy with a rate increase. Moreover, all FOMC members agree that a rate increase is warranted, and Bullard even believes that the rate should be higher than what the rest of the members think. Since we now have studied two rate statements from the Fed, we can now move to the third step, which is comparing the present statement with the previous one. So I'd like to remind you guys that the first statement that we reviewed was the January 26, 2022 statement. This was the first statement for 2022. And then we're gonna compare it with the March 16, 2022 rate statement. Here are the things that I like to do. One, I encircle changes and adjectives used to see whether the central bank is seeing an improvement or worsening of the economy. Second, I strike through portions of the previous rate statement that were deleted or removed on the present statement. Third, I underline new parts of the statements. And fourth, I insert notes to compare the changes between the two, like difference in the QE amount, interest rates, and others. So what are the changes that I have observed on the rate statements? I have here my cheat sheet. So pardon me, I will be reading parts of my cheat sheet. For the January 2026 statements, the portion where the sectors most adversely affected by the pandemic have improved in recent months but are being affected by the recent sharp rise in COVID-19 cases. This has been removed. And then what they did is they just explained that the economic activity and employment have continued to strengthen. Basically, it's the same except for this part where on the January 2026, they describe job gains have been solid. And then on March 16, they said job gains have been strong in recent months. Everything else is pretty much the same, but On the January 26, overall financial conditions remain accommodative, in part reflecting policy measures to support the economy and the flow of credit to U.S. households and businesses. This has been removed because, as you can see, they increased the rates. Therefore, it's not gonna be accommodative anymore. What they did is they added a new line, which higher energy prices and broader price pressures. They are actually explaining inflation more. And then the portion where they are describing the risk about the new variant of the COVID-19 virus, they totally removed that part and switch it to the portion where they are describing the risk from the Ukraine-Russian invasion. And then, for the next part, the next sentence is the same, but on the January 26, they said there that they have kept the target range as is. But on the March 16, they said that with appropriate firming. See the word firming. So they are actually firming the monetary policy. They are moving away from QE. They raised the rates to 0.25 to 0.25%. And take note, anticipates that ongoing increases in the target range will be appropriate. Okay. Now, moving on, after the discussion of the rates, they actually discuss the asset purchase program that the Fed is implementing. So, on the January 1, what they did is they are bringing an end in early March. What they actually did is they removed the word expect and they changed it to they begin reducing its holdings of Treasury securities and agency debt and agency-backed securities. So they already started the reduction of the asset purchase program. Right? They also removed the part where they are saying that the monetary conditions or the financial conditions are accommodative. They have removed that because it's not applicable anymore. And then on the latter part, everything else is almost the same except for the votings, because on January 26, everyone has voted unanimously to keep the rates as is. We have marked the changes that have happened to the present rate statement in comparison to the previous rate statement. I will move on to the next step, which is creating a summary of the changes for easy reference. I like to put mine on the top portion of each printed copy. If you are a beginner, it is advisable to create a table of summary showing the important notes and details in one glance so you can clearly see the direction of the central bank is going. So what are the changes that I have observed from January to March rate statement? So the risks have changed from the new COVID-19 virus variant to the Ukraine-Russian war. The accommodative stance was removed and was switched to firming monetary policy. Rates were up from 0.25% to 0.5%. This is a 25 percentage point increase and moved from increasing the asset purchase to reducing the asset purchases. On a monetary policy view, they move a step further away from QE and they move a step forward towards the neutral stance. This is not tapering yet. Therefore, the US dollar will naturally strengthen because, as we have discussed in the previous sessions, QE is not good for the value of the currency simply because it means that the economy is not doing very well. But if the central bank decides to reduce the size of the QE, that means that the economy is strong and their currency is perceived as an asset with good value. In short, USD will strengthen as well. If the USD indeed strengthens, let us check the US dollar index. So last January 26, the DXY closed at 96.483, and then on March 16, it closed at 98.405. Just by looking at the charts, we can verify that the USD went higher. By using a percentage change calculator, it appears the USD went 2% higher in between these two periods. On to the May 4, 2022 rate statement. Although overall economic activity edged down in the first quarter, household spending and business fixed investment remained strong. This is painting a mixed signal from the dollar, so I'll highlight the first part as red but the last part as green. Job gains have been robust in recent months, and the unemployment rate has declined substantially. Again, this is a positive thing for the USD, so I will highlight this part green. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. Bad news for the common people, but again, high inflation will push the Fed to increase rates again. Therefore, this is a positive thing for the USD. The invasion of Ukraine by Russia is causing tremendous human and economic hardship. The implications for the U.S. economy are highly uncertain. The invasion and related events are creating additional upward pressure on inflation and are likely to weigh on economic activity. This is the current risk the Fed is seeing. Previously, I just underlined this part, but this time I will highlight in red. In addition, COVID-related lockdowns in China are likely to exacerbate supply chains disruptions. The committee is highly attentive to inflation risk. This one I will underline for now. They use the word likely, therefore it is not yet certain whether this will actually affect the US economy. And if it does, we are still uncertain how much impact will it have. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. With the appropriate firming in the stance of monetary policy, the committee expects inflation to return to its 2% objective and the labor market to remain strong. This part is just stating the Fed's commitment to its inflation and employment mandate. So I'll leave this part alone. In support of these goals, the committee decided to raise the target range for the federal funds rate to 0.75 to 1% and anticipates that ongoing increases in the target range will be appropriate. Again, this is a good thing, but the actual impact will depend on how much rate increase the market is expecting. Based on the forecast for this data, the market is expecting a 50 basis point increase on the rates. Since the actual data is in line with the expectations, it is quite good for the US dollar. However, please keep in mind that in any event the actual is lower than the forecast, even if the central bank did increase the interest rate, it will be viewed as disappointing. And if the opposite happens and the actual interest rate is higher than the forecast or the expectations, the currency is expected to rise in the short term. I say short term because we also have to consider upcoming news and updates for both the currencies that we are trading. In addition, the committee decided to begin reducing its holdings of treasury securities and agency debt and agency mortgage-backed securities on June 1, as described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in conjunction with this statement. Reduction of stimulus means that the Fed is slowly moving away from QE. This is positive for the dollars. In assessing the appropriate stance of the monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede attainment of the committee's goals. The committee's assessment will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. Nothing of importance here, so let's leave this alone. I'm voting for the monetary policy actions where Jerome Powell, John Williams, Michelle Bowman, Lael Brainard, James Bullard, Esther George, Patrick Harker, Loretta Mester, and Christopher Waller. Patrick Harker voted as an alternate member at this meeting. Since all the FOMC members agree on the monetary policy decision, there is nothing much to learn from this part. Now, let's work on the summary table. So, in general, this rate statement is positive for the US dollar. The only risk for now is the Ukraine-Russian war, and there is an upcoming risk possibly regarding the Chinese lockdowns. Everything else is quite similar to the previous statement. Going on to some details, what has changed? First, the first sentence has changed. For the March 16th rate statement, they said that the economic activity and employment has continued to strengthen. But on May 4th, overall activity edged down except for household spending and business fixed investment. It's not a good time for the US dollar. The opening is not good. The succeeding sentences are the same, but the description for the job gains have changed. On March 16, they described it as strong, and then on May 4th, they described it as robust. Either way, both are positive adjectives, so we don't have any issues on this. Then for the second paragraph, on March 16th, they said that the invasion and related events are likely to create additional upward pressure on inflation and weigh on economic activity. But on May 4th, the word has been changed to are creating additional upward pressures. So it has been confirmed that the war has already affected the US inflation and economic activity. There is a new part inserted regarding the COVID-related lockdowns in China. In the next paragraph, the first sentences are the same except for the rates, because on March 16 they raised it to 0.25 to 0.5, and then on May 4th they changed it to 0.75 to 1%. Next, last March they said that they expect to begin reducing the holdings of treasury securities, blah blah blah. And then on May 4th, they used the word they decided to begin reducing. So they already started the reduction on May 4th. Let's check the votes. The votes are also unanimous, so they all agreed on the monetary policy changes that they have done, except there is a slight change in members. Take note, voting members of the FOMC can change. Sometimes there will be alternate voting members, but the numbers of the voting members are the same. All FOMC members will all sit down in this meeting. Everyone shares and discusses what happened and what they think will happen to the US economy. But after 2 days, only the designated voting members have the actual right to vote for the monetary policy. The non-voting members are still have a lot of influence and voice simply because they are free to share their views within the meeting. So what has changed in general from the March statement to the May statement? The first change was economic activities edged down except for household spending and business fixed investment. This is not good for the dollars. The Ukraine-Russian war started to affect inflation and economic activities. The US are not directly related to the war. the war is between Russia and Ukraine. But since these two countries are major suppliers of necessities and commodities like food, oil, and energy, it will affect everybody living on this planet. Chinese COVID-related lockdowns are expected to affect the supply chain. This is still a developing issue or risk, so we don't know yet whether this will actually affect the overall economy or will have no impact or very minimal impact. Raise rates from 0.5% to 1%. This is a 50 basis point increase, and all FOMC members voted unanimously. For this episode, we have 3 activities. For activity 7, you have to determine the impact of the underlined phrases or paragraphs on the US dollar. Write positive for positive impact and negative for negative impact. I have chosen the July 27 Federal Rate Statement to be the basis of this activity. There are 5 sentences that are underlined and each of them represents an item. As always, you may pause this video if you need time to answer. But if you're done now, then let's begin. Let us check activity number 7. Number 1. Recent indicators of spending and production have softened. This is negative. Softening of economic indicators is not always good news. Number 2. Inflation remains elevated. This is positive for the dollar simply because the Fed will have to raise the rates further to combat inflation. Number 3. The war and related events are creating additional upward pressure on inflation and are weighing on global economic activity. This is negative. If we only look at the inflation pressure, this could be positive. But on the other hand, the war is also causing global economic activity to slow down. Number 4. Raise their target range for the federal funds rate to 2.25 to 2.5% and anticipates that ongoing increases in the target range would be appropriate. This is positive. The rate is already expected. There are a lot of websites that you could go to check what the expectation is. What's important here is that they said that the ongoing increases on the rate will still be appropriate and we're still gonna expect new rate increases from the Fed. Lastly, number 5, continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. This is positive simply because this is a reduction in the QE implemented. For activity number 8, you will create a table summary for the June 15, 2022 rate statement. You have to identify which parts are positive, which parts are negative, and then underline parts which are the things or information that you need to be reminded of. I'm guessing that you are ready, so let's proceed. So what are the positive notes on this statement? Number 1. Overall economic activity appears to have picked up after edging down in the first quarter. Number 2. Job gains have been robust in recent months and the unemployment rate has remained low. Number 3. Inflation remains elevated. Number 4, raise the target range for the federal funds rate to 1.5% to 1.75% and anticipates that ongoing increases in the target range would be appropriate. Number 5, continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. Now, what are the negative notes on this rate statement? Number 1, invasion and related events are creating additional upward pressure on inflation and are likely to weigh on economic activity. Actually, when you consider inflation, it's a good thing, but since it's also weighing down on the economic activity, this is considered as negative. Esther George, a voting member of the FOMC, preferred to raise the rate slightly lower than the consensus. She believes that the rate should only be around 1.25% to 1.5%. What are the notes on this statement? There's only one, which is COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. Since we basically discuss every rate statement for the year, you will notice that it doesn't usually change a lot. The word choices, the arrangement of these sentences and paragraphs are similar, especially if they are reiterating the mandates of the Fed, which is maximum employment and keep inflation at 2%. When the change happens, that's where the direction of the currency will begin to move or change. For 2022, the change occurred between January 26 and March 16, because that's the period when the Fed decided to switch from an accommodative monetary policy to a firmer one. It was triggered by the Ukraine-Russian war. So far, everything else is pretty much the same, except for the weakening of the economic activities. We have seen softening in the month of May and another softening of the economic activity for July, and it has recovered on September and November rate statements. Let us answer activity number 9. For this one, all you have to do is compare the September 21st rate statement to the November 2nd rate statement. Underline new parts of the present rate statement and strike through parts of the previous rate statement that were deleted. You will surely need a lot of time to answer this, so feel free to pause the video. If you wish to download the original files for this activity, kindly check the description below. I have attached the link to the Federal Reserve website. So, what are the changes that happened between these two statements? For September 21, the part saying they raised the target range for the federal funds rate to 3% to 3.25% has been removed, because on November 2nd, it was changed to 3.75% to 4%. On the other hand, on November 2, the part was added. The committee anticipates that the ongoing increases in the target range will be appropriate in order to attain a sense of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy lags with which monetary policy affects economic activity and inflation, and economic and financial development. So in summary, what are the things that happened from September to November rate statement? So in summary, what are the things that happened from September to November rate statement? First, the rates were raised from 3.25% to 4%. This is another 75 basis point increase. Next, the Fed acknowledges the lag in the impact of the monetary policy in the economy. It sounds dovish, and this was clarified during the press conference an hour later when Powell mentioned that the Fed will be cautious in increasing the rates further because they want to see first the effect or the impact of the rate increases that they did this year. See, the rate started from 0.25 and it is now at 4%. Based on the statistics, it takes at least a year for the economy to fully digest the changes in the interest rates. So, based on this, I think the FOMC believes that it is the right time to observe whether the economy needs more rate hikes or all of the adjustments made were sufficiently enough to contain inflation. Lastly, all FOMC members voted unanimously on the decision that was made on this statement. I have here some tips on how to access the rate statements from the central bank website. First, we have to go to the official website of the central bank. In this case, let's go to the Federal Reserve, which is federalreserve.gov. Almost everything about the Fed, their publications, researches, speeches, and activities are here. However, don't be overwhelmed and just focus on what affects our industry, which is the monetary policy. So here we can see the monetary policy. We click that. Then, going a little bit down, you will see here recent documents. If you want to see everything, like every rate statement, every kind of documentation from the FOMC, you have to go back here to monetary policy and then click meeting calendars and information. Once you click here, you will see the year and the dates. So for 2017 to 2022, PDFs are available. This is where you can download it. You can download a PDF version or an HTML version. So this is the statement, and then on the other side, we have here the transcription of the press conference. On the lower part, there are other documents, and the minutes are on the right side. Since this is a foundation class, we're not gonna be discussing these. When we go to the master class, we're gonna dissect the minutes and the press transcript. The Fed usually updates their website to show the dates that they have chosen for the FOMC meeting. Since the market is closed from Christmas to New Year, what I like to do is prepare my own calendar and mark the dates where the central banks would be meeting. Every single central bank has their own website. So, let's go to European Central Bank. If you don't know the website, it's okay. Just go to Google or whatever browser you want and type in European Central Bank. So this will appear, ecb.europa.eu. Then, if you go to the upper middle part, you will see monetary policy. Under monetary policy, you will be able to see monetary policy decisions that were released. You click that, and the decisions, statements, and other documentations that the ECB are releasing are all here. Every central bank releases their own kind of data. It is different for each and every central bank. And there is a specific format that the Fed is following, and that other central banks have their own formats as well. But luckily, the framing of the websites are quite similar to each other, so it's easy for us to find the monetary policy statements. So some central banks meet often, while some rarely. The central banks that usually meet the most are the Federal Reserve System, the RBA, the RBNC, the ECB, and the BOE. The Swiss National Bank, the Bank of Canada, and the Bank of Japan are the ones that meet the least. Again, the number of meetings per year depends on the central bank. So for example, the FOMC meets 8 times a year. Some other banks like for example, the Swiss National Bank and the Bank of Japan like to have a quarterly meeting. Alright, I think I pretty much discussed everything about individual monetary policy statements. In the next episode, we will learn how to compare the fundamentals of one country to another. And to be honest with you guys, all of my students said that this is the hardest topic within the foundation class. So, rest well because we're gonna need a lot of focus and energy. If you have questions or in need of clarification, you are welcome to leave a comment. I will personally answer them all. Thank you for being with me and see you next week. Bye! This wraps up the second portion of the monetary policy. I'll see you on the third part. Bye!